Good morning. Today is March 18th. I'm Joe Terril, President of Terril & Company, Private Wealth Managers in St. Louis, Missouri. This is another update on our investment committee and our thoughts on not only the economy, but the investment markets, inflation, interest rates, etc. And with me today, as always, is David Carter, who does most of our fixed income, Bill Newbold and Russ Phillips, who do equities, and we will discuss what we think is going to happen in markets. But before we do that, let me make a couple of opening comments. One, that we are in such a unique time right now with the potential tariffs that the administration says they're going to put on everybody around the world. And they're supposed to start April 2nd. Very difficult for us to assure you, here is what's going to happen with the economy, here's how that's going to be reflected throughout the interest rate world, inflation, and etc., because there's not really a good precedent for this, and you don't know what the administration is going to really do. If there's retaliatory tariffs by other countries, they're saying, well, then we're going to raise our tariffs even more. And because of this uncertainty, our position is to be very defensive right now. Those that follow our videos know that we were saying at the end of last year we're going to be taking some profits. We said in January we're better sellers than buyers. We've continued this theme, and we're in the enviable position of, so far for the first quarter of this year, we have really nice gains and really nice percentage gains, while most investors are showing red ink. And I think, let me stop there for a moment, and Russ, I'll go to you first. Give our viewers an idea of kind of what's happening and how we're positioning ourselves as it relates to stocks. So if you will, Russ, take it away.
Thanks, Joe. And I went back and looked at a couple of our prior videos, and you stole my thunder, actually, Joe.
Okay.
If you go back in January, we felt that volatility was going to pick up, and that has been correct. We also did say, as you mentioned, we were going to be a better seller of stocks, and we have been. I think the important thing for our clients to know is the averages are down. It doesn't feel so bad when you look at the averages, but if you look at individual stocks, let me give you a couple examples. NVIDIA, whose CEO is speaking today at their developer conference. Everybody's waiting with bated breath to hear what he says about AI. NVIDIA stock is down just about 25% year to date, 25% from the highs. Apple, Microsoft down 20% from their highs. Tesla down 55% from its highs. So the individual stock damage, or corrections that are occurring, are much worse than what you're seeing and feeling in the averages. Over time, that will create opportunities for an organization like us that has the liquidity, and it'll provide an opportunity for us to sharpen our pencils and find some real opportunities. Bill?
Yeah, thanks, Russ and Joe. As Joe and Russ have reiterated, uncertainty is prevalent in the market. And really the markets, more than anything, don't like uncertainty. That impacts investor sentiment. And there's really no cure for investor sentiment. So as Russ mentioned, the averages are down, but individual stocks are well off their highs. And so what we've spent a great deal of time doing recently, after, becoming more defensive, taking profits in stocks, we've been actively meeting with companies and attending virtual conferences and really looking for what we think will be some nice ideas going forward. So we feel pretty good about how we postured things. We got defensive at the right time. So right now we're really spending some time looking at candidates for the portfolio, but we would emphasize, just in a period of uncertainty like this, we're being very patient, doing quite a bit of work, and so we think that's where we add value, not to rush in to make hasty decisions. There's always good stocks to buy, and we're spending some time to find those.
Thanks, Russ. Bill, would I be right in telling our viewers that if you held our feet to the fire, we think this volatility is going to continue and there could be more downside?
Yeah, I think Russ and I would be in agreement on this. As Russ mentioned, volatility is picking up. We're still early in this process, right? This is all within the last month or so with all these tariffs. So with volatility picking up, typically markets act in waves and layers, and we're still really kind of feeling our way through the tariff uncertainty, and it's our estimate that this is going to take several months to kind of play out. So it stands to reason to be patient and observe some things and to do our work on other areas.
And I would agree. I think you could see a tradable rally, but it is the low end. We might have a tradable low end, but not the low. And I still think that's out, like Bill said, a few months from now.
Thanks. Appreciate it very much. I'm going to turn to you now, Dave, with something that I find fascinating, and that is the interest rate structure as it relates to fixed income products and the potential for inflation, and with what we see going on right now. I want to ask you a question, though, about something that I read the other day, which is there's some thought out there that our budget deficit, which is $2 trillion plus, and we have to roll over debt, that if the administration is trying to power play other countries with the tariffs, those countries might power play us back by refusing to buy our debt. It's no secret that about 70% of our debt is bought outside the United States. Do you think there's any merit to that, Dave?
Thank you, Joe. Yeah, I think, yes, I think there is, and I think if you go back to the beginning of the Russian-Ukraine war, you started to see some signs of that, where central banks around the world have increased their gold buying vis-a-vis U.S. Treasury buying. So they're adding to their gold positions while buying fewer treasuries. Now the tariff uncertainties can only exacerbate that phenomenon. And the question is, who's going to be the incremental buyer of that debt? We will see. One thing I find interesting is, with all the uncertainty, the 10-year Treasury rate is at 4.30, and is actually up from, say, 4.15 area. Intuitively, you would think that uncertainty, money would flow to treasuries and flow to safety, and that hasn't happened. And that, I think, goes to some of the uncertainty on the global geopolitical tensions, uncertainty on the budget that we have in front of us, and also some uncertainty on inflation. The inflation numbers, while maybe down a little bit, are not where the Fed wants them. So we have volatility in the rate market as much as we have volatility in the equity market. And we even see that in expectations of the federal funds cuts. In February, markets were expecting one cut. March 1st, it was 3 cuts. Today it's 2 cuts. So evolving very, very quickly, and so therefore our strategy is to focus on short-term callable reset preferreds and bonds, that we can get, say 6%, in the area of 6%. And we think that's a very attractive position.
Yeah, I agree with you, Dave, and thank you, by the way, for the comments. But I agree that if we can get 6%, and in many cases north of 6%, and we're protected, because if the bonds reset, they're resetting almost at 8% or more, I'll take it. Let them reset them at a much higher rate if they don't pay us off early. And I think that's really a part of the market that investors are unaware of and don't understand. So our clients are, to that extent, taking advantage of our expertise, at least in that area, to provide good rates of return while we're waiting. And I just want to say one more thing. What is a little bit different about this, as you guys know from where we were 5 years ago, if you decided to get defensive in 2022 or even defensive back in 2018, there wasn't any alternative. Interest rates were non-existent. I don't mind us being very defensive right now because, as we mentioned, we're making 6% plus rates of return while we're waiting to see how some of this will play out. So we better stop right there for now, and appreciate everyone tuning in. Want to remind you that if you enjoy seeing our videos, you can subscribe to YouTube or hit the like button, and I believe the advantage to that is they'll notify you every time we update our videos. So Brian Curtis, who helps us put these videos together, thank you. And we'll be back, obviously, somewhere very close after April 2nd, and we see what happens with the tariffs, or maybe does not happen. So thank you for tuning in, and we'll see you in a few weeks.